Yo, what's going on, boys? Welcome back to another video. I think today is day 6. Not sure, not gonna lie. I don't know how I'm gonna keep count whenever we get to like double digits, but fuck it, we ball. Um, Last video we went over how to properly use time frames. Today we're gonna be going over two things: liquidity and just your mindset. So your mindset, how your mind should be before trading, while you're learning about trading, so on and so forth. So let's get right into it. We're going to start with your mindset. So the way I look at trading and the way a lot of people don't is that you need to realize that you shouldn't be focused on money whatsoever. Yeah, obviously you're trading to make money. I'm an idiot, and yeah, that's the point of trading, but that's not what you should be focused on. It's like, for example, like the greatest quarterback in NFL history, was he focused on the money to get to where he was? No, he was focused on building his skill in becoming in becoming the greatest quarterback possible, and therefore he made all that money. He was focused on his passer rating. He was focused on how well he could throw the ball, how he could improvise in the pocket, so on and so forth, right? So that's how you got to look at trading. You're not looking at it like, how can I make the most money today? How can I make the most money this month? How can I retire my family this year? No. The way you want to look at it is, how can I become the most disciplined trader possible? How can I follow all of my rules? How can I use proper risk management? These are the things you should be looking at. Just like that quarterback. How can I improvise in the pocket? How can I lead my receivers better? How can I be a better leader for my team? So on and so forth. You gotta think about the steps it takes to get to that end goal of financial freedom when it comes to trading, right? And it's not too much that I want to touch on, but that's pretty much all of it. So yeah, let's get right into liquidity. Just a quick little minute talk about your mindset, because I've seen a lot of people too focused on money, and I just want to tell you guys that you guys shouldn't be focused on money whatsoever. Every day you come into the market, you want to be thinking, how can I be the most disciplined version of myself possible? How can I be the best trader possible? If the best traders in the world are only taking under 10 trades a month, why are you taking 2 trades every fucking day? You have to wait for those A+ setups. If price action is terrible, you don't take that trade. If price goes against your original bias, you don't take that trade. You shouldn't be trading 10 different things. You shouldn't be trading ES and NQ and then 2 crypto coins and then fucking QQQ for options. You shouldn't be stick to one thing. You shouldn't be strategy hopping. Stick to one thing you trade, one strategy, one time you trade. So for me, that's 9:30 to 11. Have proper risk management. For me personally, I do 1 to 3% of my account size. That's what I'm risking per trade, and only one trade a day. And then I have a 1 to 2 risk to reward ratio for every single trade. And I highly, highly, highly recommend you guys do the exact same thing as I do. Alright, so let's get into liquidity. So there is 2 types of liquidity that we should focus on: internal range liquidity and external range liquidity. So internal range liquidity is fair value gaps, which we will also get into eventually. I'm not going to go into what fair value gaps is and what the other internal range liquidity things are. I'm not going to go into that. I'm simply telling you what they are, and in future videos we will go over those. Awesome. Internal range liquidity, fair value gaps, things like, hold on, where was it? Order blocks. I have to find it now. I think it was on the 1 hour. Yeah, right here. Order blocks are internal range liquidity. So, and then breaker blocks, but I don't know a lot about breaker blocks, so I'm not even going to touch on that. So for internal range liquidity, we have fair value gaps and order blocks. Okay? Awesome. I'll briefly go over what each one are. I'm just not going to go too in depth. An order block is a small move up before a big move down, and then vice versa. Let me find it. Give me a second. Give me 1 second. If I ever could. It's going to be easier to find on the 4 hour. Right here. So vice versa would be the small move down, or the last move down, before a huge move up. We didn't even touch that shit yet, but exactly, that's the point. I'm just trying to see if there's another one. No. So we have for internal range liquidity, order blocks, fair value gaps. An order block is the move up before a big move down, or the move down before a big move up. And let's say there was like 2 green candles, you would mark out both. It's not just one. But since there's a red candle right before, you don't mark that green candle over here. You just mark the move up before the big move down. And I guarantee whenever we hit this, we're going to drop even more. And then I want to find a better example for the opposite, a move down before a big move up. Right here. Right here, it is perfect. So these 3 red candles mark the highest point of the 3 and the lowest point. Okay, turn this shit off. Pissing me off. Bam. Bam. Did we tap this? Oh, we did. Oh, we did. It's the big move up, or the move down before a big move up. And you can see, right after we tap into this, we go back up. So, if it's a small move down before a big move up, whenever we retrace to it, you can expect another move up off of it. And the same thing with a move up before a big move down. If we come back into it, you can expect another big move down, because this little up move caused this big move down, this big leg down. So whenever we retrace to that, this area will cause another move down. Alright? So those are order blocks, briefly explained. I'll go over them more in detail in another video. And all a fair value gap is a 3 candlestick pattern. I hate the word pattern for trading, but I don't know what else to call it. It's a set of 3 candlesticks. It's the middle, the top, or the bottom of the first wick, and the top of the third. And vice versa for a bullish one. It's the top of the first candle, the bottom of the third. And these are on every time frame, everywhere. Okay? And I don't like to use the term price magnet a lot, but a lot of the time we will retrace to a fair value gap. And the way internal and external range liquidity works is usually, most of the time, price will hit one of them and then move to the other. So we'll tap into a fair value gap, and then, or we'll tap into an order block or fair value gap, any version of internal range liquidity, and then we'll seek out external range liquidity, which is above highs and below lows. And all it is price pushing past those highs to take out a whole bunch of stop losses, to move the other direction. Same thing with lows. It's pushing past those lows to take out a whole bunch of stop losses in order to push the other way. Because where do people place their stop losses when they're going long? Under lows. Where do people place their stop losses when they're going short? Above highs. So market pushes past those highs. We get what's called a liquidity sweep, and then we push the other way. So now we know internal range liquidity is inside of order blocks and inside of fair value gaps, and external range liquidity is above highs and below lows. So I'm actually not going to delete that. Let's go back and just look at some examples. So it might be better on a lower time frame. Actually, it probably will be better. So let me find just a pretty good example. Okay, this is a mediocre example, but it is what it is. You can see right here. Let me put my magnet back on. Bam. It's a smaller fair value gaps, but the size of the fair value gap does not matter. And let me go into replay mode. So you can see we create this fair value gap, immediately tap into it, and then, so what is that? We call that internal range liquidity. We tap into internal range liquidity. We also tap into fair value gap down here, and there is a fair value gap here, but you know, you get the gist. Actually, I'm going to use that example instead of the other one. I like that more. So, fuck that first example. You have this fair value gap right here. Bam, 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 fair value gap. Immediately after, we tap into it and we close above it up here, showing decent bullish pressure. Now we go from internal range to external range, so we're seeking out a high, which could be right above this high, right above this high, right above this high. So what happens? We didn't sweep. We didn't sweep. We didn't sweep. And then we sweep. And all a liquidity sweep is when a candle wick pushes past a high or below a low and then closes below the high or above the low. So you can see this high right here, marked it out, it's the white line. The candlestick wick pushed way up, took out all those stop losses that were placed above this high for people going short, and then took out all of those stop losses, and then came down and closed. And that's why, for a lot of the time, that's the first thing people look for their entry, is a liquidity sweep. Because do not enter if you see a liquidity sweep. That's why we're going to get to other things to use for confirmation. But that's, for a lot of traders, the first thing they need to see before placing a trade is a liquidity sweep. And then see what happens. We push down a little bit, consolidate, and then we push even lower. Look at that. Look at that. Alright. Let me remove this, remove that, and we'll go back to regular, get out of there. And then I wanted to look for a low being swept. I'm actually going to go to the 15. I want to see a low get swept and then a retracement to a fair value gap, or vice versa. We retrace to a fair value gap and then we seek out lows. And then honestly, that's pretty much going to be it for this video. Oh my god, right here. Am I dumb? This is actually kind of beautiful. Oh my god, this is a beautiful setup. Wait. Okay. So right here, we create a fair value gap. Bam. Right? What do? We retrace to it. So that's internal range liquidity. Then we go to external range liquidity, which is where? Below lows. We sweep this low, right? Let me put a little, oh my god, this magnet, man. I can't have fun. Well, fuck it, we'll keep it right there. Right there. Come out, we take out a whole bunch of stop losses that's below this low. Then what do? We rally a little higher. Rally a little higher. Then what do? We sweep this high. You see the wick goes, let me get rid of the fair value gap. Actually no, I'm gonna keep it. But you see, I'll mark it out. That high right there, move up, move down, top of the wick, it gets swept, the wick goes past and the candlestick closes below. Then, big move down. Big move down. Big move down, probably retracing. And would you look at that? And would you look at what we have here? A fair value gap. So, we swept that high. God, this shit is far. There we go. So you can see. Can I stop zooming out? We went from external range liquidity. Well, we're still inside this fair value gap, but still we swept this high, then immediately retraces all the way to this 15-minute fair value gap. So that's pretty much it. Decently short video. Yeah, internal range liquidity is inside fair value gaps, order blocks. That's all you guys should worry about for now. And then external range liquidity is above highs and below lows. Why is it above highs? Because that's where people place their stop losses when going short. Why is it below lows? Because that's where people place their stop losses below lows when going long. And market likes to take out all those stop losses in order to push the other direction. And then real quick, actually, before I end, I'm kind of going to explain why fair value gaps are like drawn to so much. And it's decently easy to grasp. It's a decently easy concept to grasp. So you can see this big green candle, right? And then we have another green candle, but it creates this gap. As you can see, it's pretty easy to see this gap. So that means inside this gap, there was a lot of buying pressure, right? So market genuinely wants, or generally, you know what I'm saying, wants to return to that fair value gap. You got decent buying pressure out of it. Yeah, we filled a whole bunch of orders in here and then got buying pressure out of it. That's all a fair value gap is. It's just a spot inside the market where, right here, inside this gap, there's a lot of selling pressure. Now, not every single fair value gap is going to work. That's not how trading works. Not every liquidity sweep is going to work. But you'll have to learn as you go. And yeah, that's pretty much it. Alright, so I will be back on Friday. I think we will do fair value gaps and order blocks then. And yeah, hope you guys learned something. Hopefully you guys had your notebooks. Hopefully you guys took notes. And yeah, see you guys on Friday for day 7, I think. Alright, see you boys later.